Well, good morning. Thank you for joining the Commodity Exchanges, Energy and Credit Subcommittee for today's hearing, which is the second in a series to examine the implementation of Dodd-Frank over the past 5 years. In February, we held our first hearing to talk about swap data standards and transparency. During today's hearing, we'll talk about the unintended consequences of some of the most important regulations following the financial crisis, the new capital standards and margin requirements for banks, non-bank swap dealers, and other market participants. On a fundamental level, derivative markets exist for hedgers, for those businesses and people who have risks that they seek to manage. And on the Ag Committee, we often think about the businesses that serve the farm economy and their ability to manage the risk they shoulder on behalf of their agricultural clients. But there are producers, manufacturers, merchants, pensions, insurers, and other businesses across our country that face similar challenges managing their commodity foreign exchange, interest rate, and credit risk. While Congress has been explicit in its efforts to exempt these end users from much of the regulatory burdens associated with Dodd-Frank, these rules could have impacts on end users if they drive intermediaries like futures commissions, merchants, and swap dealers from the markets. If this happens, hedgers will see their spreads widen, their fees increases, and liquidity fall. Without question, the financial crisis could have been tempered with stronger capital rules and margin requirements. So today's hearing isn't about the purpose or need for capital and margin standards. Instead, it's about the outsized consequences of small decisions made when designing these rules. These decisions, things like how to account for margin or the differences between cash and cash equivalents, may seem small to regulators, but they will be deeply impactful to Main Street businesses that rely on derivatives markets to hedge their risks. Regulation is about choices. Each rulemaking is built from 1,000 little decisions that are supposed to add up to a desired outcome. Over the past 5 years, financial regulators have been busy making a lot of decisions, but it isn't entirely clear if we're reaching the outcome that was intended. Today, we will examine those decisions and compare the outcome to Congress's longstanding goal to protect end users from bearing the burdens of the financial crisis. Protecting end users does not need to be a zero-sum game. I believe we can both build resilient markets and protect end users from unnecessary burdens. I want to close by thanking our witnesses for the time they've spent preparing and traveling to be with us today. The subcommittee appreciates your willingness to share your talents and expertise with us today. With that, I'll turn to our ranking member, Mr. Scott, for any remarks he might have.
Thank you, Mr. Chairman, and I want to welcome all of our distinguished witnesses. We're looking forward to your expert testimony in this very, very important area of the impact of capital and margin requirements on end users. Today's hearing is very, very important, mainly to finding that right balance between high enough capital and margin requirements to keep the system safe and low enough capital and margin requirements to ensure that the system is profitable for everyone in the industry. Our committee took particular and very great pains over the years to exempt end users from the margin and capital requirements necessary to reform the derivatives markets for the simple reason that the farmers, the ranchers, other end users, manufacturers did absolutely nothing to cause the financial crisis. And we feel on our committee that it is our job to make sure that this spirit continues in any regulations in the future. They had nothing to do with the financial crisis, and that must always be taken into consideration. Over the years, I have been very, very concerned about cross-border transactions, and I am very pleased with the ongoing work of Chairman Massad, who's doing a fine job over at the CFTC. But Chairman Massad has had a tough battle in dealing with the issue of the European Union equivalency. And so I am looking forward very much to getting your evaluation of that, where you see the progress going. Because if we do not solve this situation with the equivalency issue of the European Union, it is going to put our end users, our manufacturers, our clearinghouses, at a very, very serious competitive disadvantage. And so I look forward to this hearing, and I want to thank Chairman Scott for again pulling together a very, very timely hearing. We're dealing on the derivatives case with an $800 trillion piece of the world's economy. Many people do not know it is that large. That is a huge, and it's growing exponentially every single day. And that's why this hearing is very important. And I thank you, Mr. Chairman, and I yield back.
Thank you, Mr. Scott. I'd like to welcome our witnesses to the table. We've got the Honorable Walter Lucan, President and Chief Executive Officer of the Futures Industry Association in Washington, D.C. We've got the Honorable Scott O'Malia, Chief Executive Officer, International Swaps and Derivatives Association, Incorporated, New York, New York. Mr. Thomas Dees, representative of the Center for Capital Markets Competitiveness and Coalition for Derivatives End Users, and Mr. Tyler Galash, founder of Myrtle McKenna, LLC, Homestead, Pennsylvania. Mr. Lucan, please begin when you're ready.
Mr. Chairman, Ranking Member Scott, and members of the subcommittee, thank you for this opportunity to testify on the impact of margin and bank capital on the cleared derivatives markets. President and CEO of FIA, a trade association for the futures, options, and centrally cleared derivatives markets. Both margin and bank capital play an important role in protecting the safety and soundness of the financial system. Since the financial crisis, their roles have been heightened with the G20 leaders' commitment to both enhance bank capital and require the clearing and thus margining of standardized OTC products through regulated clearinghouses. While capital and margin are both tools in protecting the financial system, it is important to distinguish the two as each serves a specific function in meeting this important goal. Bank capital is the amount of funds that a banking institution holds in reserve to support its banking activities. Required by national banking regulators under international standards set by the Basel Committee on Bank Supervision, bank capital serves as a stable financial cushion to absorb unexpected losses by banks. Margin, on the other hand, aims to protect the safety and soundness of the futures and cleared derivatives markets rather than specific institutions. Customers that utilize the futures or cleared derivatives markets to hedge their risks are required to clear such transaction through a clearinghouse, and in order to do so, must post margin with a clearing member. The clearing member, in turn, manages this collection of margin from its customers and guarantees the customer's transactions with a clearinghouse. The customer's margin is simply a performance bond that ensures customers make good on their transactions, which offsets the clearing member's exposure to the clearinghouse. Many of the largest clearing members are also affiliated with prudentially regulated banks and thus are required to hold sufficient capital to ensure the firm and thus the system is protected. As large financial institutions, these banks are subject to both CFTC regulation for their future commission merchant clearing business, as well as bank capital regulations under the oversight of the Federal Reserve, the FDIC, and the OCC. These U.S. bank regulators, consistent with standards set by the Basel Committee, are now implementing a new type of capital provision known as the leverage ratio. Part of the goal of the leverage ratio is to set a simple, non-risk-based floor for capital, including measuring the exposures arising from futures, options, and other derivatives transactions. Unfortunately, the leverage ratio fails to properly recognize that customer margin posted to a bank-affiliated clearing member offsets the bank's actual exposure to the clearinghouse. The very nature of customer margin is to reduce the exposure of losses to the clearing member and the clearinghouse. In recent years, the CFTC, under your oversight, has made significant improvements to enhance customer margin to ensure it is always the first line of protection to offset losses during a default. If left unfixed, the leverage ratio will result in an inaccurate measurement of the actual economic exposure of the bank and assign unwarranted capital charges on its clearing business. This will lead to higher costs for end users and hedgers in our markets. Given these new capital constraints, bank clearing members are already beginning to limit the amount and types of clients that they accept to clear. We also believe the leverage ratio will lead to further consolidation among clearing members, resulting in fewer players supporting the safety and soundness of the clearinghouse. In the U.S., clearing members have decreased from 94 clearing firms 10 years ago to only 55 today. While there are several factors contributing to this consolidation, capital has been recently cited by several clearing member banks who have now exited the clearing business. Perhaps the most concerning consequence for this committee surrounds the leverage ratio's impact on a clearinghouse's ability to move or port client positions from a defaulting clearing member to another healthy clearing member during a crisis. If porting cannot be achieved due to capital constraints, clearinghouses will be forced to liquidate in a fire sale client positions during volatile market conditions, adding unnecessary stress to an unstable marketplace. After all, the ability of clearinghouses to move customer positions during the failure of Lehman Brothers in 2008 is one of the fundamental reasons that policymakers in the G20 determined to expand clearing to OTC products. In closing, I would encourage the U.S. regulatory community to work together through the Basel process in determining how margin and bank capital regulations can work in context. Without a fix, recent efforts by the G20 to increase the use of clearing may be in jeopardy, and customers in the futures and cleared swaps markets may face higher costs and less access to these risk management markets. Thank you very much, and I look forward to your questions.
Chairman Scott, Ranking Member Scott, and members of the subcommittee, thank you for the opportunity to testify here today. I'd like to thank the committee for holding this timely hearing to discuss the ramifications of two major reforms: bank capital and liquidity rules and the margin requirements for non-cleared trades. Both will have a massive and profound impact on the derivative end users. In my testimony, I'd like to explain the findings ISDA has produced to determine the cost impact of the capital rules, and will emphasize the need for a comprehensive and cumulative impact assessment. I will also provide an update on the implementation of the margin rules and the steps ISDA is taking to ensure these are implemented in a cost-effective manner. Substantial progress has been made to ensure that the financial system is more robust. The implementation of Basel II.5 and Basel III means banks now hold more and better quality capital than ever before. An additional capital surcharge is being implemented for systemically important banks, and a resolution framework is being put in place to wind down failed banks without taxpayer assistance. This is on top of the global derivatives market infrastructure reforms, including data reporting, trading, and clearing. While many aspects of the new rules have been finalized, core aspects of the Basel reform agenda, such as the leverage ratio, net stable funding ratio, fundamental review of the trading book, are still evolving. As it stands, these reforms look to significantly increase costs for banks and may negatively impact the liquidity of these markets and the ability of banks to lend and provide crucial hedging services to corporates, pension funds, and asset managers. Recent ISDA analysis suggests that the compliance with just one of the rules, the NSFR, will require the banking industry to raise an additional long-term funding. We are concerned that the cumulative impact of the different parts of the banking capital reform are still unknown, and it is our belief that regulators should undertake a cumulative impact assessment post-haste. Given the continuing concerns about economic growth and job creation, legislators, supervisors, and market participants need to understand the cumulative impacts of the regulatory changes before they are implemented. When it comes to the health of the global economy, I think the old Taylor saying holds true: measure twice and cut once. At this moment, we're cutting our cloth in the dark. ISDA has been working hard to understand the impacts of the individual rules. And over the past year, we've conducted 8 impact studies. In each case, these studies have indicated sizable increases in capital on top of the increases that have already occurred as part of Basel III. We've also found the impact was not uniform across all banks, with certain businesses hit particularly hard. One good example is the leverage ratio and its effect on client clearing business. As it stands, the rule fails to recognize the risk-reducing impact of the initial margin posted by customers, and this has proved detrimental to the economics of client clearing and is in direct conflict with the G20 objectives of central clearing. Now let me turn to the final rules regarding the margin for non-cleared trades. As I noted earlier, these rules will have a significant cost impact on non-cleared products. According to the analysis published by the CFTC, the industry may have to set aside over $300 billion of initial margin to meet these requirements. ISDA has worked closely with the market at the global level to prepare for implementation, and I'm proud to say that ISDA and its members have accomplished a great deal. First, we've established a standard initial margin model called ISDA SIM, which all participants can use to calculate the initial margin requirements. This is nothing short of revolutionary for the over-the-counter market. Second, we've worked to draw up a revised margin documentation that is compliant with the collateral and segregation rules. Third, we've established a robust governance structure to allow for the necessary evolution of the model and to provide regulators complete transparency into the model development process. Despite these efforts, challenges remain. The deadline for implementation of the initial margin requirements for the largest banks is September 2016. The variation margin Big Bang is set for March of 2017, which affects all market participants. There are still a few important items that need to fall into place to ensure that the market can move forward confidently. First, regulators need to send a clear signal that the ISDA SIM is fit for purpose and banks can confidently begin to apply this model before the 2016 deadline. Second, regulators must finalize their cross-border rules, which will result in the recognition of comparable jurisdictions. To date, the CFTC cross-border margin rules have not been approved. And if it is not rectified as soon as possible, the hard work to unify the rules under the BCBS IOSCO at that level will be undermined. In addition, ISDA will not be able to complete the necessary documentation that will assist dealers in determining whether their clients fall within scope of the margin rules by the time the rules go final. And I appreciate the committee's interest in ensuring that the G20 reforms are implemented in a cost-effective manner, and this ensures that end users have access to global capital markets and derivatives markets. You can be confident that ISDA will continue to work to develop the data on the capital rules to contribute to a safe but cost-effective capital structure, as well as facilitate the transition to a new margin regime that is fully transparent and effective. Happy to answer any of your questions. Thank you.
Mr. Dees?
Good morning, Chairman Scott and Ranking Member Scott and members of the subcommittee. I'm Tom Dees, testifying on behalf of the U.S. Chamber's Center for Capital Markets Competitiveness and the Coalition for Derivative End Users. I'm also chairman of the National Association of Corporate Treasurers. The Chamber and the Coalition for Derivative End Users, along with NACT, represent hundreds of companies across the country that employ derivatives to manage risk in our day-to-day business activities. First, let me sincerely thank both the chairman, the ranking members, and the members of this committee for doing so much to protect derivative end users from the burdens of unnecessary regulation. When it comes to Main Street businesses, the members of this committee have worked together to get things done. Last year, you led the charge in enacting both the end user margin bill and the centralized treasury unit bill, directly benefiting the end user community. We sincerely appreciate these efforts. Congress did this because they recognize that end users do not engage in the kind of risky, speculative derivatives activity that became evident during the financial crisis. End users comprise less than 10% of the derivatives markets, and we use derivatives to hedge the risks in our day-to-day business activity. We're offsetting risks, not creating new ones. We support the Dodd-Frank Act's goal of increasing transparency in and reducing systemic risks of the derivative markets. However, at this point, almost 6 years after passage of the Act, there are still areas where the continuing uncertainty compels end users to appeal for legislative and regulatory relief. End users are also seeing the cumulative impacts of the elaborate web of new rules and regulations, including those placed on our counterparties. That is, rules that require our counterparties to meet certain tests regarding capital, liquidity, and margin are leading to significant realized and potential impacts on end users. Despite being exempted from the capital and margin requirements, end users still face the distinct possibility that our hedging activities will become too costly because of the new and higher capital requirements, margin and liquidity requirements imposed on our counterparties. For example, under the net stable funding ratio, long-term funding costs will discourage dealer involvement in derivatives, thereby reducing available counterparties and liquidity for end users. We understand the banking regulators have proposed their net stable funding ratio rule this week, and we're in the process of reviewing it and its impacts on end users. Another example is the supplemental leverage ratio, which does not permit the clearing member to receive credit for the segregated initial margin posted by its end user customers. The failure of the SLR to recognize the risk-reducing effect of segregated client collateral will likely lead to fewer banks willing to provide clearing services for customers and will likely increase costs to end users generally. Differences in the credit valuation adjustment risk capital charge between the United States and other jurisdictions such as Europe also create competitive disadvantages. Europe provides an exemption that avoids the CVA charge being factored onto the pricing and passed on to end users. However, in the United States, no such exemption exists, leading to the potential for large pricing differences when trading with U.S. compared to EU banks. Many end users engage in derivatives with both non-bank as well as bank swap dealers, and we're concerned about the impact on liquidity of certain restrictions on models for non-bank swap dealers, which would not permit the use of internal models for computing market risk and counterparty credit charges for capital purposes. This approach requires non-bank swap dealers to hold significantly more regulatory capital, which ultimately will force them potentially to exit the business, leaving end users with fewer choices for access to risk mitigation tools. To summarize, end users are concerned about the apparent disparity between an exemption from clearing and margin requirements on the one hand and the pass-through costs resulting from new capital and liquidity rules imposed on their counterparties. We also fear that cross-border regulatory uncertainty and conflict could put American companies at an economic disadvantage. Although these capital and liquidity rules do not create affirmative requirements directly on end users, they nevertheless create real impacts and costs. The imposition of unnecessary burdens on end users restricts job growth, decreases investment, and undermines our competitiveness around the globe, leading to material cumulative impacts on corporate end users and our economy. Thank you again for your attention to the needs of end user companies.
Mr. Galosh.
Chairman Scott, Ranking Member Scott, Chairman Conway, and other members of the committee, thank you for inviting me here today. The testimony I'm going to give today represents my views and not those of the Trade Association or others that members. And I agree with your remarks. I actually believe that we can have more resilient markets and still protect end users. And I also want to start today by saying, recognizing the obvious, that inadequate regulation of derivatives turned a mortgage crisis into a worldwide financial meltdown. And in response to that crisis, regulators around the world designed rules to make our markets more fair, more transparent, more stable, and less likely to cause the next financial crisis. I think it's clear they've actually done that. But unlike some of my colleagues here today, I want to share with you that these important reforms are not actually having a profound negative impact on real end users. And the elaborate web of rules that my colleagues referenced a moment ago don't actually apply to them. And in part because of your hard work, but in part because of smart choices also made by our regulators. Today's topic focuses largely on margin and capital, and I think that's actually the most important part of the crisis. So the largest firms, AIG and the banks, had hundreds of billions of dollars on their balance sheets, and yet they still were not able to weather the storm, in large part because they had inadequate margin from their counterparties and they had inadequate capital to absorb the losses. So the taxpayers did. And I want to explore for a moment exactly what margin and capital are. As Mr. Lucan said, margin is the first line of defense for a counterparty. It's an asset, often extremely liquid securities. They're used to satisfy the obligation. It's been a hallmark of our capital markets for decades around the world. And it's actually the only reason to promote liquidity in times of financial stress. Capital, by contrast, ensures that the firm has enough of its own, not borrowed money, to meet the foreseeable obligations, essentially to stay solvent. If margin is the first line of defense for a counterparty in a time of a crisis, then capital and leverage limits are the last before the bailout. Once the crisis hit, everyone realized that we needed more margin and capital in the system, and the G20 summits focused squarely on those issues, and that's actually what Dodd-Frank did as well. And now we're hearing from many of the largest banks and financial firms and their trade groups here that the requirements on them will have, and I'm again use their words, profound negative impacts or impede the ability of end users to manage their risks. And I'm here to say I respectfully disagree. And the reason is, frankly, simple math. And let me use an example from real life that I'm familiar with. And it's a real commercial end user. It was a parts supplier in Michigan who has a $100,000 loan with an interest rate risk associated with that, and they want to engage in perhaps a swap to fix that risk. So now they go to a bank with a 7.5% capital. Okay. So the real risk for them may be just $1,000, the actual full risk. So the market value is $1,000. The capital for that is about $75, 7.5% of that. But we're not even talking about the $75 on this $100,000 swap. We're talking about the difference between that being borrowed money and that being the financial firm's own money. So what's the difference there? That's actually about $7.50. So what we're really talking about on a $100,000 swap is an incremental cost to the bank or to the large financial firm of basically a ham sandwich downstairs. That's the amount of money we're actually talking about. That's the profound impact of the cost that we're worried about being passed on to the end users. Again, the end user itself isn't posting any margin. It's not posting any capital. It doesn't have to keep those things. And those folks were appropriately exempted from the regulation. So one thing I want to take a few moments to talk about is who are the financial firms. Obviously, we have the largest banks who are familiar with capital and margin requirements that have applied to them for decades. But we also have the largest financial services firms. We have the insurance companies. We have the hedge funds, the mutual funds, the futures commission merchants. We have those folks. I would argue that actually that bucket is precisely the bucket that these rules are designed to target. And the reason is AIG, Long-Term Capital Management, MF Global. Those are the firms that we actually do have to worry about. And for them, margin and capital rules, some of them may apply, and some of them are not very familiar with it, and I recognize that. And then, of course, we have the real end users, the farmers' cooperatives, the manufacturers, those types of, they had nothing to do with this crisis, and no one agrees that they did. And I think what's interesting is we're doing our best now, and I think with your committee's great work, making sure that these rules don't apply to them. The last point I want to make is something that my colleagues also referenced with respect to the cross-border issues. I share the concerns with both mutual recognition and making sure that our regulators work collaboratively around the globe. I think with respect to whether or not we exempt or our regulators cede jurisdiction to others, I would say be very careful. It was, in fact, the London trading desks of some of the largest firms that led to some of the largest losses. So I would urge them to be careful. Again, thank you for inviting me here today, and I look forward to any questions.
Before we go into questions, I want to remind people that any member may submit their opening statements for the record. I should have done that prior to the testimony. I apologize, but anybody who has an opening statement is certainly welcome to submit it for the record. I would like to remind members that they will be recognized for questioning in order of seniority for members who were here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate your understanding. Mr. Lucan, so I understand that capital requirements are important to the big banks, but this is the Ag Committee. Why should our nation's farmers and ranchers be concerned?
Well, in the futures markets, a significant amount of the cleared business runs through bank-affiliated FCM. If you look at the stats the CFTC puts out, it's somewhere in the order of 87% of the cleared products come through bank-affiliated FCMs. And so this is going to have knock-on effects that will affect agricultural customers who will have to pay more as a result of that. Many of them are using bank-affiliated clearing members to clear some of their business. In addition, there is less capacity on behalf of these non-bank affiliates. So even though if they reach a capital constraint because of the leverage ratio, there is not capacity elsewhere to accept these types of positions in non-bank affiliated FCMs. So these costs will have to be passed on to customers. It's going to be more than a ham sandwich, as Mr. Galesh indicated. I mean, the numbers are significant. I think we're estimating somewhere in the order currently of $32 to $66 billion are going to of cost will be as a result of this. So those costs will have to be passed on in significant ways to customers. I would like to make the point, too, that this is not just talking about products, swap products that were in the over-the-counter markets that have come into clearing. This is affecting futures products. Products that had nothing to do with the financial crisis are now being taxed as a result of these provisions. That affects farmers directly and users directly and should be of concern of this committee.
Thank you. Mr. Amalia, in your testimony, you stated that the impact of the new rules on individual business units or product areas could be disproportionate in the difference between a bank choosing to stay the course or exit the business. Generally speaking, what drives a bank's capital allocation decisions?
Right now, it's the rules. The rules are having a huge impact on where they're going to allocate capital. And as Walt pointed out in in his testimony and in mine, the leverage ratio is a very good example of that. These requirements are going up, and all of these rules and a cumulative impact are not being fully assessed. So we have a multitude of these rules being developed now that are going to be implemented over the next 4 years that individually have serious consequences to the investment decisions and the capital decisions that each of these banks are going to have to make, which will have pass-on effects. I can tell you, in developing these rules at the CFTC, we were very cognizant of how this would impact end users, and we worked very hard to make sure that the margin rules did not impact end users. That is not the case with the capital rules. There is no exemption in the U.S. capital rules for exemption for end users.
Mr. Dees, the concerns you shared in your testimony are highly technical and nuanced. Did the prudential regulators consult with the hedgers who use derivatives for risk management purposes to understand how their rules would impact your ability to use these markets? And do you think that the regulators understand your concerns?
Mr. Chairman, thank you. Well, certainly both the Chamber and the Coalition for Derivative End Users have been very active in submitting comment letters and other ways to make the prudential regulators aware of the concerns of end users. But I would have to say that there has not necessarily been a very active two-way dialogue in that regard.
Gentlemen, thank you for your testimony. Now recognize the gentleman from Georgia, Mr. Scott, for 5 minutes.
Okay, thank you, Chairman Scott. I'd like to see if we could get to this issue of the cross-border. I mean, in each of your testimonies, you all touched upon it, and I think it's a very, very critical issue. Now, we've been wrestling with this equivalency situation with the EU for the last, seems like 2 years. I mean, it's just been on. It's supposed to have been resolved last June. Then it skipped and it said we'll resolve it in October. Then the deadline was stretched to December. So where are we now? How serious is this? Mr. Dees, you touched upon it. I think each of you have. But here, there's something else that worries me about this. You take other countries that the European Union has dealt with on equivalency. You take countries like Singapore that have the same robust, strong regime and regulatory regime as the United States, Australia, as the United States. And they got EU equivalency. Now, what's going on over there? Why is this discrimination happening by the EU to our United States when they are allowing other regimes with the equal robust regime to come in and get that equivalency? Is there something rotten in the cotton that we're not hearing about here? Because what you got to me is you got the United States and you got the European Union are the two mightiest markets here. And it could very well be maybe the European Union is saying, maybe we need to cause a little more difficulty here so that they can get a gain on the competitive edge. Am I right or wrong about that?
I'll take a first shot at that. I mean, this is a very important issue for our industry because it is a global marketplace, as you mentioned. The EU and the United States have reached a tentative agreement on that, and that's still working its way through the European Commission and the European Parliament. But it has to go into effect by a deadline in June. The problem is that there was a very lack of transparency and lack of a process involved with this, something that should have, as you mentioned, taken months, took years in order to work its way through. That was the derivative side. The security side is still not decided. They have the SEC and the EU have not reached a decision on equivalence on the securities clearinghouse side. So this is still playing itself out. What we as a trade association have tried to say is let's develop a process. We have due process here in the United States. We have CFTC has to abide by certain APA recognition or APA transparency. I think there should be a process developed here so the EU and the US can enter into these decisions, people can voice their concerns, and we can quickly get past these things. But equivalence does not mean exactly the same. Equivalence means that these things are comparable and we have the same outcomes. That's where we tend to stumble between the EU and the US.
Ranking Member Scott, this is a great issue, and as Walt pointed out, it is a global market, and therefore we need global rules. We have been working very hard to make sure that to minimize the differences between the rule sets and to ensure that you can have comparable regulation. That's what was set out in the G20 objectives. That's what we believe is the outcome in many of these regulations, as you pointed out with Singapore, the EU as well. These rules are not going to be identical. You cannot read them word for word and come up with the identical rules, but the outcomes are the same. And so we're pushing very hard, whether it's data, whether it's trade execution, how you comply, our firms, buy side, sell side, end user, it does not matter. They are all working, we're all working together to make sure you have comparable rules. One frustration, recent frustration is, and I touched on this in my testimony, is the ability, the CFTC's own rules on cross-border have been inconsistent. On one hand, they put out the guidance 2 years ago that really kicked off some frustration globally about equivalence. With the cross-border equivalence decisions coming, or that need to come as a result of the non-margin rules, or the margin for non-cleared rules, excuse me, they have a different position. The definition of U.S. person is different. And so you have the CFTC offering two different potential solutions between their draft rules and their guidance. Complying with each of those from one agency would be virtually impossible. So we would urge the Commission to, A, finalize its rules and then be consistent with the prudential regulators that are already out. And then we probably ought to go back and reevaluate the current guidance that they've issued.
Right, my time is up, Mr. Chairman. If we have another round, I would certainly like to come back and ask what impact this controversy is having on our end users.
All right, we should have time for another round. I now recognize the gentleman from Texas, Mr. Conway, the big chairman, for 5 minutes.
Well, thank you, Chairman. In full and fair disclosure, Austin and I finished up the markup at NDA last night, or early this morning at about 2:45, so not necessarily hitting on all four cylinders. Belt suspenders is a phrase that CPAs use a lot, and I'm a CPA. But as I look at this net supplementary funding ratio, net stable funding ratio, supplementary leverage, Basel 2.5, Basel 3, capital surcharges, at what point does it get too much? I mean, we're overlapping these kind of things, and so that's a question I think that for broadly put that more broader look at a step back. And now that we've got all these rules in place for the most part, what is it we've actually done to ourselves, and how has this actually stopped any kind of a meltdown going forward? But I would like to get in the weeds a little bit. Scott, in your testimony, you talked about the ability of a bank to use internal models to calculate their capital requirements. If that's eliminated, then it's estimated that they'd have to come up 2.4 times as much capital as their internal modeling would describe. Internal models that bad? Or I mean, that seems like a pretty dramatic differential between the way the regulators would say and the way the banks have seen, because they're responsible to the shareholders at the end of the day as well. What causes that big difference?
Yeah, well, I think it's important to put it in a bit of perspective. Following Basel II, regulators came up with the idea that actually you should have more risk-sensitive models appropriate to the bank, and they allowed for internal models to be used. And these are supervised, overseen models. These are not out of sight and out of mind. The regulators get a look at these, and they were developed to be more risk-sensitive, which is the appropriate evaluation. In the recent submission on the FRTB fundamental review of the trading book, they have a higher standard for internal models. They've potentially reduced the ability to use internal models, and the difference on various asset classes could see a sizable increase in capital requirements. And as you noted, and our research shows, it could be as high as 2.4% or 2.4 times more capital. We think that there's no perfect model. And we think that models should be used, internal models should be used. And we are in favor of making them more transparent and working with the regulators to ensure that standard data is used, benchmarking is used, to make sure that they have a high level of confidence in the models so they can be used. If you go to a standard model, they're less risk sensitive, more conservative, and will require more capital. And we want to make sure that we don't have kind of a standard model that used kind of a one-size-fits-all, which is inappropriate for the industry.
Gotcha. Mr. Jellis, you mentioned, and pardon me if I mispronounced your last name, ham sandwich.
Yep.
Whose hide did that ham sandwich come out of?
Pardon?
Whose hide did that ham sandwich come out of?
The banks. They're actually, they're the ones who actually have to.
What was their profit margin before the ham sandwich?
So that's actually a really interesting question. So if
I guess there is a profit margin to them.
Pardon?
Is it okay for the banks to make money?
Absolutely.
Okay.
Absolutely.
So that ham sandwich cost didn't get passed on to the end user?
We don't know. And so out of a $100,000 swap, the $7.50 or so that the costs for the bank, the incremental costs of having it now.
Is that a number you'd multiply by to get to the 8 trillion? In other words, the ham sandwich is a pretty trivial amount, obviously.
Right.
But do they do a lot of $100,000 swaps?
No, but a lot of end users do. So you start to talk about $100,000 swaps or $1 million swaps or $100,000 swaps. The actual incremental cost here is just the incremental cost of whether or not it's borrowed money or whether or not it's their own money. That's the difference between the capital. So that is actually the number we have to worry about. It's not the total amount of capital that they have. It's the cost of that being borrowed money.
Give me a perspective. I don't know. I mean, I know what a ham sandwich is, but how does that? What was the profit margin to the bank before the ham sandwich? And is the extra cost of the ham sandwich worth them staying in the business?
So, yeah, and the answer is almost assuredly yes. And so the market risk for them was $1,000 on the example I used. So the market risk was $1,000. For them, they may very well charge, we're talking about, in the example I would use, we're probably talking about hundreds of dollars. So the incremental cost to them is literally a few percentage points.
Okay. They charged hundreds of bucks for $1,000.
They may charge, they may charge $100 for $1,000 to be willing to take that interest rate.
And you're pretty confident that that charge won't go to $107.50?
I can't say I'm
to the end user.
So the question is, how much of that will be passed on? And I think the answer is, we haven't seen it. So a lot of these rules have actually already been implemented.
Based on your background.
Yep.
Ever seen anything that wasn't passed on?
Yes, to the extent that there's limitations on that. So one of the things I would say is we do have actually a relatively competitive environment. One of the things we've actually seen as some of these rules have come on is in the interest rate environment, we've actually seen bid-ask spreads narrow. We've actually seen liquidity in some cases actually improve. So, and we've actually seen costs come down.
I keep using the word, and I'm way over my time.
Yeah.
I keep using the word some.
Yep.
And I'm just trying to get a perspective on that, because you're the only person that's ever come in here, other than a regulator, and been as happy with the rules as you seem to be. I yield back.
No, I wouldn't actually say I am as happy as I am, but I do think that they are generally very good rules.
All right. Chair now recognizes gentlelady from Arizona, Ms. Kirkpatrick.
Thank you. Mr. O'Malley, I want to follow up on your comment that one size doesn't fit all in terms of capitalization. Can you give me an example of what you mean by that?
Sure, thank you for the question. So the analysis we've been doing on the FRTB, and we'd be happy to provide it, there's an index or an annex in there that does elaborate a little bit more in my testimony.
I would appreciate that.
Yeah, so the analysis we looked at, using the internal model, we believe that the FRTB capital model will increase capital requirements, risk-weighted basis, 1.5 times. Without the ability to use internal models, we believe that could go to 2.4 times the capital requirements. Now, it's not completely binary. Some banks may be able to use capital models, some may not, but it's in that range of the capital increase that we've estimated for the FRTB rule that was just recently released. Now, it would also have, due to our estimates, impacts on FX foreign exchange. You could see in that asset class, as well as securitization and equities. But as an example, and kind of at the high end, FX could go up by 6.4 times based on our analysis. Now, this would be a big impact, and people would use FX hedgers and users for commercial operations, for global operations, right? They paying salaries, recouping revenue, raising money in different countries. That would have a big impact. And keep in mind, these are global rules. These are not just U.S.-specific rules, so this affects all the global exchange in dealing with this. So this is not just U.S.-specific. But those are our specific examples that I could give you, and we have plenty more details in our more thorough study that we've included.
I would appreciate that. Has there ever been a situation where a market participant had insufficient capital? And if so, what happened?
Under the
Market
the Basel-
participant.
Yeah, well, they've had, regulators would insist they raise that capital requirement.
Well, what really happens? Aside from that,
You have a conversation with your
impacts.
regulator, and they expect you to put more capital behind it.
But can you give me an example where there was a market participant who did not have enough capital?
We can,
I can see, I mean,
Yes, it will
then
be-
prudential banking regulators would require you either to, go out in the debt markets to raise more capital or issue stock to raise more capital, but you would be out of compliance with prudentially regulated regulations that require a certain amount of minimum capital. And
I guess what I'm trying to find out is what is a common sense sort of approach to good capitalization? So you're basically saying it's in the hands of the regulators. I get that because of the regulations, but I'm trying to find out, are those regulations sensible? Is there another standard for looking at what makes good capitalization? So that's what I'm trying to get at.
well, in that case, you and I are looking for the same thing. And what we see is the individual rules are being promulgated, and we're watching them individually. What we haven't done, and what we would be strongly in favor of, is kind of looking at the comprehensive. And we have to look at the individual business lines as well. The leverage ratio, for example, is a tax on clearing. That is diametrically opposite with what the market regulators have kind of urged market participants to do, put more into clearing, which is the right thing to do. But then the capital rules kind of send the conflicting message in taxing clearing by not recognizing the initial margin as risk offsetting. Now, the individual rules we'll look at and try to assess the impacts on individual businesses. And those rules are being developed currently, right? These aren't done, we haven't seen the final rules in most cases, and they will be developed and implemented over the next 4 years. So we're trying at this point, at this important point, before they're fully implemented, let's understand the real ramifications of the individual rules on the individual businesses, and let's do a cumulative impact to really understand the broader economics.
Thank you. That's what I'm after, and my time is running out, but I would appreciate more information on that. I will tell you that it's been my experience that in crafting legislation and regulations, too many times we do think that one size fits all, and it doesn't work. So I appreciate the panel's testimony. I yield back.
The chair recognizes the gentleman from Mississippi, Mr. Kelly, for 5 minutes.
Thank you, Mr. Chairman, and Mr. O'Malley. In your testimony, you stated that we need to understand the cumulative effect of these regulatory changes on the economy before they are fully implemented, and I agree with you. However, I'm assuming the proponents of the changes would argue that the potential adverse effects of the economy could be much greater if we don't expeditiously implement the changes. How do you respond to such claims?
Well, we have time to do that now. There's nothing to stop these rules from going forward and doing the cumulative impact assessment right now. These are Basel rules. They're going to be promulgated and moving forward. The leverage ratio, fundamental review of the trading book are near final anyway, but they have time to be implemented over the next 4 years. We do believe that a cumulative impact assessment and really looking at the individual business line impacts would be informative to understanding the ramifications. I think a lot of people, and with all due respect to Mr. Glash and his ham sandwich, a lot of these rules have not been fully implemented and costed in. As I mentioned, the non-cleared margin rules have yet to take effect. Those are going to have a $300 billion impact. These are CFTC numbers, not my numbers, CFTC numbers. And those are going to be real ramifications. The capital rules are not finished yet and are going to be phased in over the next 4 years. We haven't seen the full price of this. We have seen what the cost of clearing is done. We have the SIFMA AMG has put out and surveyed their members, $34 trillion under management from those asset managers, pension fund managers, and they are saying from their membership, yeah, we are seeing price increases. These are going up. We're seeing fewer people that we can deal with in this derivatives ecosystem. And it is an ecosystem, right? You need risk managers and you need hedgers, and all of that has to work together. And these capital rules, as I said earlier, aren't exempting end users, right? These costs will be passed on.
And kind of going back on your line and following up with what Chairman Conaway talked about, it's easy to say that when things don't generate income or revenue, that those costs are passed on to the banks. However, I spend quite a bit of my time in the district speaking with banks and constituents, and my experience has been that most of the time, whether it's a ham sandwich or a Mercedes-Benz, that cost is generally always passed on to the consumer because the margins keep getting thinner in this world, and generally that's passed on to consumers, which basically blocks people out from being able to get income that they need. Do you agree?
Fully agree with you. Thank you.
Mr. Lucan, why did the G20 call for the imposition of margin and higher capital requirements, and how does the posting of margin and holding additional capital reduce systemic risk?
Well, I think the G20 looked at the example of the futures markets and how well they worked during the financial crisis. And when Lehman Brothers went down, the futures business easily moved to other clearing members that were healthy and able to accept those positions. So that ability to port something from a failing institution to a healthy market participant allowed the markets to function, to price discover during that process, while some of the over-the-counter markets froze up with uncertainty. And so they looked at that example and said, clearing seemed to work during a crisis situation. Let's consider bringing some of these products in a more transparent, regulated environment that allows for daily posting of margin. So when people put on transactions, they're able to put up this performance bond that ensures there's money sitting there, cash money regulated by the CFTC in case that one of those parties defaults. And that's the first line of protection. You'll talk to any clearinghouse, talk to Chairman Massad of the CFTC. It's always there in a crisis. And what we're asking is simple math. Recognize that it's always going to be there during a default and subtract it from the exposure that the bank has to the clearinghouse. It's cash. It's easy to measure. It is simple math. So please do that so that we're not taxing clearing as these products come into this more healthy, regulated environment.
And I had another question, but I'm going to run out of time. I thank all you witnesses for being here and taking the time to explain this extremely complex math to most of us regular folks. And Mr. Chairman, with that, I yield back.
The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, the former chair of the big committee.
Thank you, Mr. Chairman. And one of the great things about the committee hearing process, as the committee knows, and I'm sure our witnesses have experienced, there are issues that are so important that they have to be discussed and discussed and discussed in order to burn it in. So in that regard, Mr. Lucan, I'd like to turn to you in specific about, once again, discussing in the many instances where clearinghouse members or banks that are subject to the Basel capital rules, which require them to hold that capital against the guarantee they provide for their clients. As I have personally repeatedly said in many of these hearings and in conversations even with Chair Yellen, we can all agree that banks have exposure in the event their clients are unable to fulfill their obligations and should hold capital against that. We all agree on that. But I'm concerned about my constituents in the energy and ag business going to find, how are they going to find access to risk, to access their risk management tools if the margin posted isn't even recognized under the Basel leverage ratios? Would you expand for just a bit on that? Because after all, as been discussed here earlier, if the banks don't want to participate in this, they don't have to, reducing competition and reducing the opportunities for my constituents in the real world. Would you expand on that?
And the effects are not theoretical. We've already had 4 bank clearing members pull out of the business, citing that capital is too expensive to continue on in this world. I think there are others on the sidelines that are waiting to determine whether these will be implemented and whether it will be fixed by the time these provisions go into effect in 2018. So this has real consequences on end users. They may have less access to clearing members because there's less choices, and they're just, as we see in the numbers I cited, they're decreasing significantly over the last several years, and that will expedite itself if this is not fixed in our community. I would want to mention, too, the costs as banks measure this. They measure things in business units. And so as a bank, as one of these banks may look at this, they will look at the clearing business itself and realize that the capital that clearing business has to rent in order to make a return is so expensive because of this lack of an offset that it's just we're not willing to do that within that business unit of the bank. We have other more profitable parts of the bank that we'll put that capital towards, whatever that might be. And so I realize that we talk about some of these costs, but the cost to the clearing business is significant. It is not a hugely profitable part of these banks. And so these types of costs are really bearing down on whether these clearing members decide to stay in the business or not.
And access is critically important to my constituents. As we've gone through this downturn in the last 6 months, broadly in ag and energy prices, had those tools not have been available to my folks back home to soften this, we would be in dramatically worse shape. Let's go one step further. In your testimony, you note, referencing Basel III and the capital requirements, you note that the consolidation of the Futures Commission merchants, something like 60% over the last 10 years. Expand for a moment on, in addition to the capital issues, what's driving this consolidation within the industry?
I think it's fixed costs. I mean, you can look whether it's the fixed costs of regulation. More volume is necessary to flow through these intermediaries in order to make it a profitable business. And so you have people who are shuttering businesses, people who are merging. So you're seeing that over that period of time where people are deciding to either just get out of the business itself or to offer, try to merge those businesses in order to get more volume to go through those things. So that's regulatory costs. We realize that, and some of those are very important and needed, don't get me wrong. But it's capital costs, and it's this cumulative effect that Scott mentioned. We got to look at all the costs that are being thrown onto this system, and that's going to cause less people to be participating in that system by definition.
So ultimately, if we have an environment where no one wants to participate, that means the opportunities for my Aggies and my energy folks are reduced, and those few opportunities come at a higher cost, and they ultimately suffer the real price.
Absolutely.
Thank you, Mr. Chairman. Yield back.
Chair now recognizes gentleman from Illinois, Mr. Davis.
Thank you, Mr. Chairman, and thank you to all the witnesses. Kind of a follow-up to my colleague, Mr. Kelly, and my colleague, Mr. Lucas's line of questioning. Mr. Lucan, now, if the banking regulators won't recognize the customer margin as reducing the clearing members' exposure, are the Basel standards actually discouraging, in your opinion, the collection of client margin and thereby, as Mr. Lucas talked about, the effect on his constituents and my constituents and all of our constituents who want to use this process? Are they discouraging clearing?
Yes, I mean, I think we're already seeing certain clearing members divorcing themselves of clients in order to reduce the capital burden in this area. So As I mentioned, some have gotten out of the business, but beyond that, there are people who are shedding clients, offboarding them in order to get into compliance with this standard. So yes, it is happening, and yes, it's discouraging clearing.
So you're reducing the amount of clearing members that would want to participate in this process for our constituents to participate in the futures, the options, the swaps market, et cetera. Therefore, reducing the number of clearing members, which wouldn't that ultimately raise the cost?
Absolutely, and that's what we're seeing.
So much more than a ham sandwich.
Oh, absolutely, and like I said, this is being viewed from the futures side of the business, which is normally a small part of these institutions. So it is a much bigger cost for those business segments than it is for the entirety of the bank, which is having a huge impact.
Okay, so premium ham sandwich or the whole hog? Actually, the whole hog would probably cost less on the market, right?
Just to add a quick interesting point on that. One of the things I think we've seen is actually the consolidation is a real concern. It's actually one that's not unique to this. The largest financial institutions have cheaper borrowing costs and economies of scale that smaller firms simply do not. When you talk about
So you would rather us just have the larger firms?
Absolutely not. I think, but the challenge there is the same thing we have in this context as we do all other business lines that banks and financial firms are engaged in. We've seen a consolidation that's not just in the derivatives and not just in these markets, but in others as well. We've seen that in commercial banking as well. One of the things that I think is really important here is when we talk about what that means, what that consolidation means. Does it mean higher costs or not? Actually, I would look at is the actual cost of doing a trade, what that means in terms of pricing, what that means in terms of bid-ask spread for doing that trade, and what the implementation cost is for that trade. And actually, by those measures, actually costs are coming down, notwithstanding this consolidation. So I just wanted to make that point.
So costs are coming down, consolidations are happening. We have, in the banking sector, as we've seen in the rural area that I represent, there aren't as many community banks anymore. It seems to me that we're getting to the point where we might actually have too many. We're getting to the point where we only have the banks that are too big to fail. Are we going to see the same thing on the clearing side, Mr. O'Malley?
I just find some of this debate, on one hand, you have the argument that this doesn't cost any more than a ham sandwich. Then you're talking about massive dislocation and concentration of things. The regulators intended for these to have change behavior, right? They impose capital requirements to increase the quality and the quantity of capital. The costs are going up, and they're not going up by a little bit or a ham sandwich. They're going up by billions of dollars. And to Walt's point, there is consolidation, and there are people making decisions about whether they're going to be in this business or that business, and there will be thousands of layoffs as a result of that. That is going to have huge ramifications, not to mention the service they're provided. And so we see, whether it's the coalition of end users or it's SIFMA AMG, they're all raising their hand saying, hey, regulator, pay attention. The cost to serve my customers or to manage the pension funds that we do is going up. Clearing costs are going up. The fact that you don't, as a result of capital, and they've pointed at the capital rules. So you can't have it both ways.
And my constituents are losing access to be able to participate in this marketplace too. Correct. And Mr. O'Malley, I got a question for you really quick. You stated in your testimony that we need to understand the cumulative effect of these regulatory changes on the economy before they are fully implemented. I agree. You just briefly touched on that a second ago. I'm assuming that proponents of these changes would argue that the potential adverse effects on the economy could be much greater if we don't expeditiously implement the changes. I mean, can you expand on that in your testimony a little bit?
Yeah, I guess the proponents shouldn't worry if it's only going to cost a ham sandwich. They shouldn't be afraid of the facts on this one. So let's move on. Let's do a cumulative impact study if there's no harm there. So the facts are going to tell us where this thing ends up. And at the end of the day, we'll all be better informed as a result of that. And that's exactly where we should be. We should understand the cumulative impact as well as the individual business line impact.
Thank you. My time's expired, Mr. Chairman.
The chair recognizes the gentleman from California for 5 minutes.
Oh, thank you, Mr. Chairman. I think my constituents would rather that we talk about a tri-tip sandwich, given the ranches we have up there, but or maybe move on from the sandwich. But Mr. O'Malley, we were talking earlier about the CFTC has yet again to put out the final rule on cross-border trades, and the implementation's going to be required for that in approximately 4 months, is my understanding, which is a very short window of time for the final rule. And so important compliance decisions are also needed as well. So if the CFTC does not come to a decision in this timeline, and the discussions continue to drag on, what would the effects be on the uncleared swap marketplace?
Confusion in one word, but it's more complex than that. So that we would appreciate the CFTC moving expeditiously to put out its final rules. We would like them to be as consistent as possible with the global framework.
So say it again, you don't want speed, you'd rather have?
No, we do want speed.
You do want, okay.
We want
All right,
both.
okay.
We want speed and consistency. We obviously, with the end deadline a few months away, it's important that we know what the final rules are going to be so we can draft the appropriate documentation to link the industry together.
How possible is it going to be that it's going to be speedy and consistent at this point?
Depends on how soon they get this out. If we have the final rules, excuse me.
You can take a moment.
Sooner rather than later, then we'll be in much better shape. What we're trying to do.
Well, what are your feels on, how do you feel they're doing on issuing them at this point? You think they're going to be pretty snappy getting them out, or?
We don't know. It's up to the commission to figure that one out, and we hope sooner, and we hope consistent. Consistent with the other regulators.
Does it have to be a difficult process, or would it be pretty straightforward?
I think they're making it more difficult than it is.
Yeah.
It should be more consistent, and unfortunately, the CFTC is in a tough position. Either they're going to submit rules that are consistent with their original guidance 3 years ago on cross-border, or they're going to submit rules that are consistent with the prudential regulators on non-cleared margin. And if they go with the prudential regulators, then they're inconsistent with their original cross-border guidance on who a U.S. person is and some of these other factors. So either way, they really need to kind of step back and ultimately revisit their entire cross-border strategy, because it is making the entire process more complex. It does create some ill will in Europe, and which is going to create a pushback.
How big has that pushback been? I mean, we've been hearing about that for at least a year or more, that it's a threat. What's the effect been so far, or has it really come to pass yet?
Well, obviously, the CCP recognition and the equivalency took 3 years to get through. I think it's really important. Nobody wants to have rules that create gaps, right? We want, and I can understand, and having been a former commissioner, Walt's been a former commissioner, you want to draft rules that are consistent, and you want to make sure that you've thought of everything. But that doesn't mean that you regulate everything. And we can rely on the global partners here, because at the end of the day, they've really developed rules that are going to achieve the same outcome. Data reporting, largely the same in the outcome, but they can't share data because they don't have it in a format that works. Trade execution's a big factor that's coming into play with the European rules around the corner. We've seen fractured liquidity in the markets today. Are you going to fix that, or are you going to sustain that, is a big question. Are you going to recognize a global liquidity pool, or are you going to have regulatory friction that divides the markets? The non-cleared, I have to give regulators a lot of credit on the non-cleared margin. Those rules are as consistent as any rule set they've developed yet today. And the goal has been to make sure that we have a global non-margining framework. So I do compliment the regulators on that. Now it's down to the final strokes. Let's put forward a cross-border system that recognizes that they are nearly identical, and we move on from there, so we can reliably, our members can deal with these rules and use substituted compliance. So you either have to comply with the rules in one country or the other, but not both.
That sounds very sensible. Quickly on the difference between, on compliance decisions between outcome-based and an element-by-element approach. You mentioned that a little bit earlier as well. Why is the, could you elaborate just a little bit on why the outcome-based is the preferred approach?
Well, let's take, for example, end user. The definition of end user in the U.S. is one definition. The end user in Europe is another definition. If you look at that and you try to do it on an equivalent basis, you're going to come up with a different outcome. You're not going to say that those are not equivalent end users. Pension funds, for example, are end users in Europe. They're not here. So applying those rules, if you go at a very granular level, you're going to find some differences, and you can never find equivalency. You can never trust the other regime, and therefore the industry is left complying with two sets of rules, which is exactly where we are on trade execution, exactly where we are on data reporting.
Thank you. Thank you, Mr. Chairman.
We're going to go to a second round of questioning. I'm going to recognize Mr. Scott from Georgia first in that second round.
Yes, thank you. I want to continue my first line of questioning and to pick up on my colleague that just spoke on the other side concerning the cross-border and specifically this situation with the EU. And I want to ask you all, is this putting our American businesses at a competitive disadvantage right now? That's what I want to hear. If you're a clearinghouse, if you're someone like ICE, Intercontinental Exchange, if you're CME, if you are a farmer, if you're a manufacturer, if you're American risk manager, hedge manager, does this uncertainty at this moment in time, is this putting our American businesses at a disadvantage
That's
in the global markets?
That is the same question the regulators in Europe or in Asia ask their constituents as well. How are we, so everybody wants to make sure that they protect their industry, they protect their people, they protect their markets, and I understand that, and that does create, tension at the beginning of any conversation on equivalence, and they want to make sure that they've thought of everything, and we want to make sure that the outcomes achieve the same thing, because you do not want to have an unlevel playing field that tips it one way or another. Now, we don't have all the rules completed in Europe yet, so it's tough to tell on some of these competitive things or competitive issues around trade execution. We did get to an outcome we have a draft outcome on CCP recognition that would make the jurisdictions equivalent.
But if you, Ms. O'Malley, if you had to answer my question right now, would you say is this uncertainty, this delay year after year, month after month, is it putting American businesses at a competitive disadvantage?
I would answer yes. I mean, because uncertainty always leads people to do less of something in order to account for that uncertainty. So the outcome, if the United States was not recognized by Europe, and it looks like we're going to be, there's a transition here, but many of the European banks that are members of the CME, of ICE, could not participate in those markets. It would be the capital punitive damages would be so high that they just have to be out of the business. And again, what does that do? Well, that shrinks choices for customers that can't access markets through those clearing members. It's going to necessarily raise costs because of that. And so, yes, it's going to cause an immediate impact.
And do you feel that it would be helpful in any way for us here in Congress to begin to put on the table and discuss any retaliatory means that might be necessary, whether you take them or not? But there ought to come a time when we need to stand up for our American businesses and say enough of this. I mean, we don't deserve this level of disrespect for our American businesses. Is there a message that we can send here in Congress to let them know that this has to be straightened out, is unfair to our businesses?
Well, I think your oversight responsibilities in this committee have been helpful. I think, you've talked about this issue in several hearings, and that has gotten both Chairman Massad leverage in these negotiations. But, the rest of the government is also important. The Treasury Department represents the United States in these types of negotiations. So I think your oversight responsibilities have helped to break this logjam. Yes.
Yeah, I wanted to get to Mr. Dees as well in my last minute here, Mr. Dees, because if I remember in your testimony, you really hit on this competitive disadvantage. What say you about this?
Well, thank you, Ranking Member Scott. That it is an important issue, and I can tell you that just to bring it home, if we're competing against European companies whose regulators have exempted derivatives they enter into from higher capital requirements, then we as American companies are going to bear a higher cost for hedging the risk inherent in our business activity. And we've estimated that the difference here could be 10 or 15% of the hedging costs. And we would have to either absorb that cost or pass it through to the customer, putting us at a competitive disadvantage.
Thank you very much, Mr. Chairman. I appreciate that because, especially Europe, because if it weren't for America, those folks in Europe would be speaking German right now.
More of them than already are. Yes. Thank you, Mr. Scott. I have a couple of questions, Mr. Amalia, that I'd like to follow up on. Are margin and capital rules complementary? If so, should they be developed and implemented in tandem to minimize regulatory overreach?
Right now, they are moving forward in tandem, and I think we ought to look at them for the cumulative impact that they are going to be having to the business. They happen to be coming in at the same time, and businesses are making very difficult decisions right now about how they deploy that capital. The margin rules are separate, and that is going to have a big impact on the pricing of the OTC market. And we have yet to see kind of how it will be phased in and what the cost of that will be. That will be phased in over the next 4 years. But I think now is the time to ask ourselves a question about the cumulative impacts of these and spot the problems before we create some of these problems that we've identified today.
So you pretty much answered my next question. I'm going to ask it anyway. I think you just answered it as no, just in a maybe a little longer manner. But the question is that how the CFTC and the prudential regulators approach their respective rulemakings, ensuring that the capital regulations took into consideration the risk-reducing effects of margin requirements?
We'd obviously like to see the CFTC get their cross-border rules out quickly. That's been a big holdup, but by and large, the margin rules on a global basis are fairly consistent.
Has the Basel Committee, the Financial Stability Oversight Council, or any other body undertaken a review of the potential cumulative impact of the various margin and capital requirements to ensure that those regulations are not unduly duplicative or overburdening the markets and their participants?
Not that I'm aware of.
Thank you, gentlemen, for being here. And the Chair now recognizes the gentleman from Illinois for 5 minutes.
Thank you, Mr. Chairman. Mr. Deas, quiet. Got a question for you.
Yes, sir.
In your testimony, you comment that requiring dealer counterparties to provide required stable funding for 20% of the negative replacement cost of derivative liabilities before deducting the variation margin posted is a clear example of the direct burdens that would affect end users' ability to efficiently mitigate risk. Can you elaborate, since we talked about end users a lot in this hearing, can you elaborate how this requirement directly impacts them?
Congressman, I'll be very happy to. Thank you for that question.
Thank you.
Well, end users deal with these banking institutions as derivative counterparties who are represented by, in some cases, over 200,000 employees. And the only way those employees act are directed by the management of the bank is to price their derivative transactions, as an example, on the incremental cost. So the way it would work in this regard, the assessment of the mark-to-market risk of an uncleared derivative would generate a funding requirement that has to be held in reserves equal to 20% of that exposure. And according to the net stable funding requirements, they have to hold 50 to 85% of that funding in long-term funding, either equity the bank has issued or long-term preferred stock or long-term debt that they've issued, the cost of which has to be passed on to end users. And we estimate that the effect of that is to increase the hedging costs by 10 to 15%.
10 to 15%?
Yes, sir.
Much higher than what we heard in some of the testimony earlier today.
Yes, sir.
Thank you. Mr. Lucan. You talked about, or we've had some discussion on, and you mentioned in your opening testimony that, other jurisdictions overseas they're in the process of implementing leverage ratio standards based on the Basel leverage ratio. How far along are the EU, Japan, and Switzerland in implementing these new standards based on Basel?
Well, they are in the midst of Basel was implemented, the Basel III in 2010, but there are revisions that are out for comment right now. And in fact, they have talked about the leverage ratio in that consultation, and they're asking for data on whether that should be fixed. Europe has taken a different direction on this. Mark Carney, who is the governor of the Bank of England, has come out with the same concerns that I'm talking about today, which is, why are we taxing clearing in this capital regime? And so the Europeans are thinking about going their own direction. So if indeed Basel decides not to recognize margin in these capital provisions, that Europe may decide to legislate its way out and just not implement the leverage ratio to tax clearing. That would be very harmful for the markets. We're trying to have internationally coordinated standards here through the Basel Committee. And if Europe is going its own way and the U.S. is punitively taxing clearing, that will end up harming U.S. businesses in the long term. So there is a process. This is happening over the next several years, but major decisions on this are being made over the next several months. And so today's hearing is very relevant and timely in that regard.
Okay, and you take it a little bit further. Can you state for the committee, do you believe or don't you that this may cause problems for banks that obviously fall under multiple jurisdictions?
Absolutely. This is an international issue, but international regulators have differences of opinion on this. And so, the fact that there's a disagreement between the market regulator, the CFTC on this, and the prudential regulators here in the United States, that may have international consequences on how this standard is put into place internationally.
So we've seen that members of the European Parliament, I know Kay Swinburne, Welsh member of the European Parliament, has brought up this idea of the EU fixing unilaterally the leverage ratio, even if other jurisdictions like the U.S. are in opposition. I mean, do you foresee such an effort there, or do you think, as you just mentioned before, that there might be a better compromise through other means?
Well, our hope is that this works its way through the Basel process and there's a satisfactory resolution. But you have members like Kay Swinburne, Marcus Ferber, who I met with last week as a member of the Parliament in Europe, Jonathan Hill, the EU or European Commissioner that covers these markets. I mentioned Mark Carney. So there's growing consensus in Europe. I can't predict what their legislature will do there, but there's growing consensus that this is a problem that needs to be fixed one way or another.
So you'd like the agencies to fix it and keep the politicians out, right?
Exactly. This, like I said, this is simply measuring the actual economic exposure of banks. We're not asking for an exception. To me, this is just measuring it right. Let's measure what the actual risk is, and then let's move on.
And keep the politicians out, just like here.
Exactly.
Thank you.
Yeah.
Gentlemen, thank you for being here for this review of the impact of capital and margin requirements on end users. Before we adjourn, I invite my ranking member, Mr. Scott, to make any closing remarks he has.
Well, just very briefly, Mr. Chairman, this has been a very, very important hearing and a very essential one. But I do hope a message has gone out from us members in Congress, particularly on this cross-border thing. Number one, each of you recognized and articulated that this failure to deal with the equivalency situation with the EU definitely puts our businesses, the American businesses, manufacturers, end users, and all of those clearinghouses at a distinct competitive disadvantage. And it is my hope, the reason I stress this is that I serve on this committee, ranking member. I'm also on the Financial Services Committee, but I'm also a member of the NATO Parliamentary Assembly. And some of these same people I deal with the EU. And that's why I want a very strong message going out here today that we need to stop this foolishness with discriminating against American businesses, or else there will be retaliatory moves made.
Thank you, Mr. Scott. Under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional material and supplementary written responses from the witnesses to any questions posed by a member. This hearing of the Subcommittee on Commodity Exchanges, Energy, and Credit is adjourned.